Well, hello everyone. Hope everyone's doing well. Thought we'd start a little bit differently today because today is April 15th. And in the United States, that means your taxes are due today. So rather than a picture of me, I thought we'd start with a picture of how many Americans greet April 15th. There you go, looking like that. There's good news, however, this year, and that is because of the coronavirus, the IRS has extended the deadline for paying taxes this year from April 15th until July 15th. So many Americans, rather than looking like this, are looking a lot more like that. All right, so with that out of the way, let's take a look at what we have coming up. Chapter 12 quiz this Friday at midnight, and then a week from today is your final interim submission, which is the business plan, finance and administration section. So that's due 1 week from today. All right, so with that, we're going to pretty much pick up where we left off on Monday. And on Monday, we talked about 4 main financial statements that businesses use. And we covered 2 of them Monday. The balance sheet, which answers the question, what do we have? And the income statement, which answers the question, how much did we make? Well, we're going to look at the other 2 today, and the first of those is the statement of owner's equity. And that answers the question, how did what we own, our owner's equity, change over some period of time? Want to know that, right? How your owner's equity has changed? This allows you to do it. So let's walk through it. You take your owner's equity at the beginning of the year, and then you add how much you made during the year, your net income. If you're a corporation and you paid out dividends, you have to subtract that, and you end up with owner's equity at the end of the year. Okay, so for the college shop, they started at 150, they added 30 in net income, so they ended with 180. They're not a corporation, they don't have any dividends to pay out. So let's take a look at their balance sheet and their income statement to see where they grab these things. That's the balance sheet we looked at on Monday. So as of the beginning of the year, January 1st, they had owner's equity of $150,000. During the year, okay, so this is the year ended December 31st, they made $30,000 in net income. Okay, and so that plugs in right there. They had 150, they added 30, they ended with 180,000. So the statement of owner's equity is really as simple as that for a small group like the college shop. And if you're a bigger corporation, okay, you'd have to say, did we pay out any dividends? So I'm going to show you an example of a bigger corporation. And we're going to do it with a quiz, another pop quiz, which means we give you the answer, right? So ABC started the year with $1 million in retained earnings. Okay, they had net income of $500,000 for that coming year and paid out dividends of $200,000. What did they end up with? And it's really as simple as that. They started, they added this, they paid out this, and they ended with $1.3 million. So if you were given that question, it's as simple as setting up the equation like this and doing the math. So that is the statement of owner's equity, which means there's only one more financial statement we need to look at, and that is the statement of cash flows. And this answers the question, how did our cash change over the course of the year? So it shows sources of cash and how we used our cash. And the statement of cash flows breaks that into 3 sections: operating activities, investing activities, and financing activities, because those are the 3 main activities that businesses perform. Operating, day-to-day operations, okay? Buying and selling goods and services. Investing, that's more the long-term assets you need to run your business. So if you bought property or plant or equipment, Those are investing activities. And then finally, financing activities. Those are funds from either starting or expanding your business. So if you issued more stock or you paid back an investor to get things started, those are financing activities. So statements of cash flow are broken into each of those three sections. And what I thought we'd do, now that we've talked about all four, is show you an example of a big corporation and what their statements, their financial statements look like. And since we talk about Marriott a lot here, I thought we'd use Marriott's and show you what their financial statements are. So, Marriott just published their 2019 annual report. Let's take a look at that. So it starts with a letter to stockholders from the chairman, Bill Marriott, and the president and CEO, Arne Sorensen. And look at this. Their very first thing, they talk about coronavirus and COVID-19 and the impact on their financials. Now, even though this is their 2019 annual report, obviously it's just coming out now because it takes a long time to finalize all the information. So the first thing they talk about is that. This is hot off the presses. It was just published in April. So they talk about that. And then the next thing you're going to see is this is the Form 10K. Okay? That's what the Securities and Exchange Commission, the SEC, calls your annual report, a 10K. If it said 10Q, that's your quarterly report. Marriott also has to report quarterly to the SEC through a 10Q, but this is their annual report, so it's a 10K. So, let's see what's next. Table of contents. Let's find their financial statements, and there they are right here. Financial statements on page 42. All right, so let's take a look at their, look at that, financial statements on page 42. So they start with a note from their registered accounting firm. We're going to take a look and see if it's one of the big four. And then there's their financial statements. Number one, income statement, statement of income. Then they have a supplement to that because they're a global firm. And then look, balance sheet, statement of cash flows, statement of shareholders' equity, the same four we just looked at. And these are all notes to their financial statements. So let's take a look at them. Okay, here's their note from their independent auditor, their accountant. Let's see who it is. Ernst & Young, EY, one of the big four we talked about on Monday. And so here's what EY said. We've audited the statements, and look at this, in conformity with U.S. generally accepted accounting principles. See that? GAAP. That's GAAP. U.S. generally accepted accounting principles. Because they're a public company, they have to be done according to GAAP. And here is EY saying, yep, that's what we did. So let's look at their financial statements. And the first one is their income statement. And this should look pretty familiar to you. Okay, they have it for 3 years, 17, 18, 19. And look, revenues, expenses. Okay, that leads to operating income. You subtract interest. You get income before taxes. You subtract your taxes, and you end up with net income. Right? It looks just like the college shops, even though this is the largest hotel company in the world. It looks similar. That's their bottom line, right there. Then they break it, because they're a corporation, into earnings per share. But that's their income statement. It looks similar. Okay? That's their supplement. Again, foreign currency, because they're a global corporation. But let's move next to the balance sheet. They show 2 years. Assets, liabilities, and shareholders' equity. Assets, $25 billion. Look at that, it balances. Liabilities and shareholders' equity, $25 billion. So again, this should look very familiar. Assets, current assets first, right? Cash first. Property, plant, and equipment, long-term next. Intangible. And then the same with liabilities. Current first, long-term debt, right? Very similar. And then shareholders' equity, because they're a corporation, stock, and retained earnings. Okay, again, Just what we talked about for their income statements. Okay, let's see what the next one is. Statement of cash flows, the one we talked about today. Operating activities, investing activities, and financing activities. There again, they broke it into those three. They had cash coming in from their operating. Some years they had cash coming in, some going out from investing, and cash going out from financing, issuing stock or whatever they did there. So, statements of cash flow. And that leads to the final one, which is your statement of shareholders' equity. Okay, for the year ended 2018, and 2017. Again, just what we talked about. Here's where they were at the beginning of the year. Added net income, paid out some dividends and stock they bought and sold, and they ended up with this. And again, added net income, paid out some dividends, bought and sold stock, ended up with this. Same thing, net income, dividends, ended up with this. So, the same financial statements the college shop used, and really they look pretty similar for a corporation as big as Marriott. Those are the four main financial statements that you will use ultimately for your businesses. Okay, so with that, we're going to move on to financial ratio analysis. And this is where we're going to spend the bulk of today's lecture. So let's start with a definition of what it is. And then I'm going to show you a short video, it's about 2.5 minutes, that provides a nice summary of financial ratio analysis. But our definition is, it's a comparison of financial statement accounts, and it allows you to evaluate your performance over time, against competitors, and against the industry as a whole. Think of financial ratio analysis as a shortcut. A shortcut, because that's really what it is. You saw how complex some of those financial statements are. If you just want to get a quick overview of, hey, how we're doing, you can use financial ratio analysis to do it. And if you want to know how you're doing, what do you want to know how we're doing against? Well, typically, time, right? How do we do versus last month, or last quarter, or last year? Against your competitors, right? If you're Nike, how are we doing versus Under Armour? How are we doing versus Puma, or versus the industry? How are we doing versus the athletic apparel industry as a whole? That's what financial ratio analysis allows you to do. Okay? So before I show you this video, just talk about the four main types. There's liquidity ratios, okay, that show you, okay, how quickly can I turn our assets into cash if we need cash to pay stuff? That's liquidity ratios. Leverage ratios, how much do we rely on debt versus equity? How much do we rely on debt versus equity? Efficiency or activity ratios, how efficient are we? And then finally, profitability ratios, right? How profitable are we? We want to know that. So with that, let me show you this quick video, 2.5 minutes, that does a good job of outlining that.
Financial ratio analysis explained in 3 minutes. Sometimes it's not enough to simply say a company is in good or bad health. To make it easier to compare a company's health with other companies, we have to put numbers on this health so that we can compare these numbers with the numbers of other companies. So now, how do we use numbers to assess company health? This is where financial ratios come in. Very common types of financial ratios are liquidity ratios, profitability ratios, and leverage ratios. Liquidity ratios can tell us how easily a company can pay its debts so that the company doesn't get eaten up by banks or other creditors. An example of this is the current ratio. This tells us how much of your company's stuff can be easily changed into cash within the next 12 months so that it can pay debts which need to be paid also within 12 months. The higher your current ratio is, the less risky a situation your company is in. Now moving on, profitability ratios can tell us how good a company is at making money. An example of this is the profit margin ratio. This tells us how much profit your company earns compared to your company's sales. Normally, a higher number is better because you want to earn more profit for every $1 of sales that you get. And finally, what about leverage ratios? These can tell us how much debt the company is using to make the company run and stay alive. An example of this is the simple debt ratio. This tells us how much percentage of a company's assets are paid for by debt. Normally, a company is considered safer when the debt ratio is low. Note that this is just a very simple overview. There are a lot more financial ratios and many different ways of using them.
Okay, so I think that was a pretty good overview of financial ratio analysis. So we're going to take a look at those same. He talked about 3 in that video, and we're going to look at 4, but that includes 3 of the ones he talked about, which are liquidity, leverage, and profitability. We'll cover activity as well. So let's start by taking a look at liquidity ratios. So again, these measure a company's ability to pay off their short-term debt. So why is this important? Well, you don't want to run out of money, okay? So it's important to know how liquid a company is. And the higher, the better, okay? It's current assets over current liabilities, so you'd like to see, generally speaking, assets over liabilities. So let's take a look at the college shops and see what their current ratio is. Current assets over current liabilities. Okay, so here's a college shop. Current assets are $125,000, right? Current liabilities are $25,000. So the current ratio for the college shop is 5. 125 over 25. They have a current ratio of 5. And you can now look back at current ratios for the college shop in prior years or against their competitors or the industry and see how they're doing. Is 5 good? It depends. Every industry is totally different, so you really have to look just at that industry. Think of a grocery store versus a jewelry store versus someone that sells lumber. Totally different businesses. So that's why you just have to use these ratios to compare within an industry. Can it be too high? Can current assets be way more than liabilities? Could that be a problem? The answer is, yeah, it could be too high. Kind of like when we talked about GDP growth. You really want that between 2 and 3%. You don't want it a heck of a lot higher than that, because that could mean the economy is heating up too fast. Okay, there's going to be inflation. That means you have to raise interest rates, and that could lead to a downturn or recession. You don't want GDP to grow too fast. Similarly, liquidity ratios, why could they be too high? Well, a couple reasons. Since we know it's current assets over liabilities, you could have too much cash. You could have too much money sitting there, and it's not doing anything for you. It's not helping you. It's not helping you with your returns. Could that cash be put to a better use? Could you be investing that in equipment? Could you be hiring more people? Could you be doing something better than just having the cash sit there? In many cases, it could be yes. So that could be a problem. A second problem could be maybe you have too much in inventory. Okay, current assets, cash, and inventory. If you have too much in inventory sitting there, maybe that's saying we're not selling it as fast as we should. There's too much sitting in inventory because it's not selling that fast. So it is possible for a liquidity ratio to be too high. Generally speaking, the higher the better. But as with everything, you have to keep in mind there's a balance there. It could be too high. So that's liquidity ratios. Let's see what's next. Leverage ratios. Okay, what do? Measure the extent to which your firm relies on debt. We know that leverage is debt. Now here, because the debt ratio is total liabilities over total assets, typically the lower the better. The lower the better. Okay? You'd rather have more in equity than liabilities. So let's take a look at the college shop's leverage ratios to hammer that home with an example. Okay, here's their total liabilities, okay, 100 plus 25, okay, their current liabilities is 25,000, long-term 100, so they have 125,000 in total liabilities. Their assets are 275. So, if we went back to their debt ratio, we know it would be 125,000 their liabilities over 275,000 their total assets, and that gives them a debt ratio of 0.45. 125,000 divided by 275,000, 0.45. That good or bad? Well, if total liabilities to total assets is less than 50%, and this is, right, it's 0.45, that means your firm relies more on owner's equity than borrowed money. That's probably a good thing. So again, let's just take a look. Owner's equity was 150 for the college shop. And we saw their liabilities were 125, so that's absolutely right. They rely more on owner's equity, 150, than they do liabilities to fund their assets. Okay? So again, 0.45, less than 50%, probably pretty good. Now, can that be too low? Just like we asked if liquidity could be too high, could this be too low? Can having little or no debt be a bad thing? What do you think? The answer is yes, it could be too low, and I'm going to give you an example. What if I came to you and I said, I want to borrow $1,000 from you, and I'll pay you 10% interest in a month? You think, wow, 10% interest in a month, that's pretty good. I don't have $1,000 though. But you think, what if I go to one of my friends and I say, can I borrow $1,000 from you, and I'll pay you 5% interest at the end of the month? The friend loans you $1,000, you take the $1,000 and give it to me, I pay you back 10% at the end of the month, here's $100, thank you. You only borrowed at 5%. So you take the 100 you got from me, you pay your friend back 50, and you made $50, right? You borrowed it at 5%, you loaned it to me at 10%, and you made money. That is called positive leverage. Positive leverage. And companies use it all the time. They borrow money at a lower rate to buy stuff that's going to return at a higher rate. Okay? So, in that instance, having debt is good because you have positive leverage. You're borrowing money to make a higher return. Okay? So, it is possible for leverage ratios to be too low. It's generally good to have some debt if there's positive leverage. Okay, let's take a look at what our next ratio is. We've covered two. There's two to go. Activity, also known as efficiency ratios. Okay, this was not covered in the video, and generally speaking, the higher the better here, and we're going to use the example of inventory turnover, which is just sales over inventory. Now it makes sense. You'd want sales to be as high as possible versus your inventory, because that means you are turning them over. You're selling things quickly. That's what you want to have. Now, in order to calculate this, you need to have actually two balance sheets. Inventory at the beginning of the year and inventory at the end of the year, because it's sales really over average inventory. Because we don't have two balance sheets for the college shop, I can't show you that. But that's how they work, okay? Sales over inventory, and generally speaking, the higher the better, because you're turning over sales. And that is going to bring us to our final ratio that I wanted to talk about, which is profitability ratios. Profitability ratios, okay? They measure the overall financial performance of your firm. That's good to know, right? The two main ones, gross profit margin and net profit margin. So, let's see how the college shop performs here. These come from the income statement, okay? And gross profit margin is your gross profit, for them $225, over your sales, $500,000. So, college shop has a gross profit margin of 45%, $225,000 over $500,000. What's their net profit margin? Well, that's net income, $30,000, over sales, $500,000. So what's their net profit margin? It's 6%, $30,000 over $500,000. That's how you calculate it. You just take that information from your income statement. So again, you can see how this is a shortcut. You're not looking through all your financial statements. You're just taking individual accounts and putting them together into a ratio, and that way it allows you to look how we doing this year, how we do last year, how we do the year before, how are our competitors doing versus us, how do we stand versus the industry. It's really a very useful tool. Now let's see, how is the college shop doing? Okay, they were at 6%, we said, not net profit margin. Well, you could make the argument they're in the retail apparel business, and typically retail apparel business is in the 4 to 7% range for net profit margin. So they're right in the middle of that. They're doing fine. Grocery stores, where might their net profit margin be? Well, they're generally pretty low, maybe 1 to 3% range. Because grocery stores really make their money on volume. On volume. They sell a ton of stuff as opposed to the margin. So they have a lower profit margin, generally speaking. What's a company with a high profit margin? Give this some thought. I bet you can come up with it. How about Apple? Yep, they've got a high profit margin. Their net profit margin closer to 20%. In fact, let's take a look at some of Apple's ratios. This shows you just how valuable ratio analysis is. Look at all the ratios that have already been calculated for Apple. There's the current ratio. We looked at that. There's the debt ratio. We looked at that. There's the net profit margin ratio. We looked at that. There's the gross margin. So their gross profit margin is 37%. Their net profit margin, look at that, 21%. That is massive. These are all different ratios. We looked at inventory turnover. There's a lot more than that. And it is a useful tool. You can see this website calculates it for you. And they show it over years. So current ratio, look at that. That's Apple's current ratio from 2010 to 2019. So you can quickly see, how they doing? And if something looks funny, then you can go back into the financial statements and try to get more of a picture. But this just shows you a quick look at how they're doing. Net profit margin. This also shows, look, their income statement, okay, for the years. You can just quickly look at this website. Here's their revenue, right? Here's their expenses. Here's their net income for 2019, 2018, 2017. Same with their balance sheet. You wanted to take a quick look at Apple's? There it is. There it is. Total assets, 338. Liabilities and owner's equity, 338. Cash flow statement, same thing. And as we know, that shows information from operating, investing, and financing. So, all the information we're talking to you about is very useful information, and it's things that people in business do use and do look at. There's the information right there. Okay, that's been a lot of numbers so far today. I get it. So I thought we would show a short clip from your favorite The Office. All right, it's only about a minute. Okay, so I'll bring this up in a second. And because I'm more of a management kind of sales guy than I am an accounting guy, I like this clip because it shows the sales guys from The Office having a raid on the accounting people. So it's kind of cute. Let's see if we can bring this up here and show it to you. All right. Little bit of fun there, right? An old-fashioned raid. I can safely say that in 30 years in business, I never participated in a raid like that. But looks like fun. Looks like fun. All right, so that's it with ratio analysis. Just a couple more things to talk about today. This is going to be a relatively short chapter. And one of those is open book management. Okay? Open book management. Let me read what that is. There is a trend toward transparency in businesses today. And transparency just means sharing financial information, being open, being transparent with how you're doing and what you're doing. Now, we just saw that public companies, they have to do it, okay? Marriott has to report things on a quarterly basis, on an annual basis. There's things they have to do. But if you're a private company, I think it makes sense to be transparent as well, is to show information to your employees. And I would agree with this. It may enhance job satisfaction and motivation because people like to know, hey, how does what I do contribute to the overall performance of our company? I feel like employees do feel like they're empowered, and it's going to have a positive impact on quality because they're going to feel good about it. If you ask yourself, I wonder if employees really care about this stuff, I will tell you in my experience, they absolutely care. We used to send out a quarterly video, and it would be just a couple of minutes, and we send it to everybody in our region, and it just went over how are we doing? What business did we win? What stuff did we lose? Who did we hire? What's happening in different offices? Who has an anniversary? What awards might we have gotten? Just kind of a quick overview. I would get more feedback on those videos than almost anything else we did. So it was really a useful tool. And I think one of the reasons that it went over so well is that we were very honest in those things. It wasn't just a propaganda to say, oh, here's how great we are. We had credibility because we gave good information and bad information. If we had a tough quarter where we didn't make our budget, where we lost an account, we'd say, here's what happened. Here's why we didn't do so well. But you'd also say, okay, here's what we're going to do moving forward to address that. We lost this, but we have this in the pipeline. We're working on this. We're moving forward on this. Okay? So it was always that type of an approach in these videos. But we wanted to be very transparent about what we were doing. And you know what? Our employees really enjoyed it. They liked it, and they came up and they told us, we like this. So I would encourage you as future managers, as future leaders, whether you're in a private company or a public company, to be transparent, to be open, because your employees will like it, and I think it will make them more motivated and more happy to work at your businesses. Okay, so we talked about public companies. They have to do it on a regular basis. Since we talked about Marriott today, let's see what Marriott does. So they have an investor relations page right on their website. And look at this, financial press releases right there. Their SEC filings right there. Earnings reports right there. So, financial press releases, there you go. Anytime something that's important comes up, they send out a press release. System incident, fourth quarter results, they just hired somebody, they just paid their dividend, they wanted to let people know about that. They acquired a group, they send out a press release. Okay? So, it's good. Good information. And then earnings report, every quarter, they have to supply information on their earnings. And look here, isn't this interesting? Earnings call transcript with Q&A. And here you can actually listen to an earnings call. Earnings call? What is that? What's an earnings call? Well, by law, public companies have to have a phone call that anybody can listen to. You don't even have to be an investor. Anybody can listen to these things where they talk about how they're doing. It's the SEC wants public companies to be very transparent, which is why they require quarterly earnings statements that anybody can look at. They require phone calls. And so there is the transcript. You can click on that and see what was covered. Or if you want to listen to it yourself, there you go. These calls are typically about an hour, give or take, and they follow a pretty set agenda. Generally speaking, it starts with an introduction. So maybe the head of investor relations gets on and says, okay, here's how we did for the quarter, and I'm going to introduce the CEO and the CFO to talk to you about it. Then typically the CEO gets on. In this case, it's Arne Sorensen, who we saw before, and he'll give really the overview. Here's how we did for the quarter. Here's kind of big picture how we did. Then typically the CFO will get on and they'll walk through the financial statements and start going over the finances and the details. And then there's a Q&A. And typically there are analysts who work on Wall Street that analyze Marriott and other players in the hospitality industry. They get to ask questions, and then the CEO and the CFO generally answer those questions. And that takes about an hour, wrap it up, and they have a transcript, and you can listen to it. So it's kind of interesting. And you don't have to be, just Marriott. If you're interested in other companies, you can just pull them up and take a look. So let's take a look at a website that allows you to do this. So, earnings cast, latest calls. Okay, these are phone calls from corporations that recently happened. Levi Strauss is one you've heard of. So if you wanted to hear how Levi Strauss is doing, you could click on this. And look, it's an hour and 8 minutes. Okay, and there's a little bit of information in it. You can click on that and you can listen to the phone call. So there's Levi Strauss's, and if you want to say, gee, I wonder what calls are upcoming that I might be interested in, well, there you go. Upcoming calls. Johnson & Johnson, that'd be interesting with the coronavirus going on. So would Wells Fargo, Bank of America, United Health, they'd all probably be interesting calls. And they're open to anybody. Just click on them and you can listen to them. Now you can't ask questions, that's just for the analysts. But earnings calls are available. Kind of interesting. All right, that is going to bring us to final slide of the day. Final slide of the day. And since we started this chapter talking about ethics, because when you think accounting, you got to think ethics. We have to be ethical. We have to be open. We have to be transparent. We have to be truthful. I thought we'd close with it too. Accounting standards and ethics. So let's break it down into the different types of accountants there are. Because we started the chapter talking about management accountants that are internal and financial accountants that are external. So public accountants are those that work in the financial accounting field. Okay, that's the big four. That's accounting services. They provide accounting services for a fee. Public accountants. Okay, you might have heard of the designation CPA. If you're a public accountant, you can get the CPA designation, a certified public accountant. And public accountants typically perform three main services. Auditing, they audit books, tax preparation and planning, and management consulting. Those are the three main services that public accountants provide. Now let me ask you a question. For public companies, can they provide all three of those services to one public company? Do you think they can? Well, generally speaking, the answer is they cannot. They cannot. Because the SEC, okay, and largely through the Sarbanes-Oxley Act, says we think it's a conflict if the same company provides auditing and consulting services. Now, why might that be? Why might that be a conflict if one accounting company provides auditing and consulting services for a company? Well, their concern is auditors might be afraid to challenge something if they think, you know what, our consultants probably recommended this. So they say, you know what, we don't want that. We don't want the same company doing auditing and consulting. They fear that back with Enron, that was one of the problems, that Arthur Andersen, the auditor, said, you know, the consultants, the Arthur Andersen consultants, boy, they make a lot of money. They're very profitable. Consulting is typically more profitable than auditing. So we don't want to say, you know, we're not sure about this. We don't know if you should have done this. We don't want anyone saying, well, wait a minute, you guys are the ones who told us to do it. You're the consultants. Okay? So the SEC doesn't want that to take place. So generally speaking, you can't audit and provide consulting for the same company. Private management accountants, okay, those are the ones that work for a business or a nonprofit or a government. They're typically the ones that do management accounting. They provide internal accounting. And you can get a designation for that too, a CMA as opposed to a CPA. Okay, so that's the difference between public accountants and management accountants. And we've talked about Sarbanes-Oxley, right? A response to Enron, WorldCom, Tyco. We saw that video on Monday of Enron, and that's why senior executives need to certify now, right? We talked about, because boy, back then when it was big trouble, the CEO blamed the CFO blamed the president blamed the accounting company. Everybody was pointing fingers at somebody else, and so now the CEO and CFO have to certify, we've seen these financial statements, we agree with them, we're fine with them. Okay? So, with that, that is the end of our accounting chapter. Again, I know, a lot of numbers, but important. Okay? Important for you to have this basic understanding of accounting. As always, if you have questions on anything, feel free to email me. Happy to address those questions. So with that, everyone, stay safe, take care, and we'll be in touch again on Monday.